Hey guys, it's Luca from FoilMagicCards.com, and today I'm going to talk about diversification. It's going to be kind of like a very mathematical video, maybe a little bit boring for some, but we're just going to go ahead with it anyways. It's a super important topic in investing, and it's going to apply to whatever kind of investing you do, whether you're investing in the stock market, crypto, magic, whatever. You're going to have to think about diversification. You're going to have to think about do I want to put all my eggs in one basket, or do I want to kind of hedge my bets, put a little bit here, put a little bit there, put a little bit in this other place, and kind of the obvious idea of what's going on here is like, okay, if you put all your eggs in one basket, you got that chance for the highest returns, but then you also have the highest risk, because what if that goes wrong? And then if you kind of spread your bets out evenly, you're kind of like protected from the downside, but obviously there's not much upside, right? So first of all, let's just talk about diversifying. Like, if you're super diversified, like, what are you even doing? Like, are you even investing? You're kind of just like putting your money everywhere at once. To me, that doesn't really seem like investing. To me, investing is like using some kind of critical thinking, trying to think about what could be worth more than it is now, and thinking about what are good investments, what are bad investments, and putting your money into the good investments and not into the bad investments, right? So right off the bat, like, I don't feel great about diversification as a concept, and I think diversification has just become kind of this thing. You just like hear about it everywhere. The quote unquote experts are always talking about diversification, so you just kind of assume it's a good thing without actually going through the math. And I think it helps to go through the math. So let's have a very simple example. Okay, so let's say you have investment 1. Okay, and it has a 50% chance of going up by 20%, and let's say it's got like a 50% chance of going down by 10%. Okay, and we've got investment number 2, and this is going to be kind of a silly example, but let's say investment number 2 has a 100% chance of going down by 20%. So it pretty much always goes down by 20%. Do you want to diversify investment number 1 with investment number 2? You really don't, right? Because in any case, investment 2 is going to be worse than investment 1, right? So right off the bat, you can see mathematically how there are going to be situations where it just doesn't make sense to diversify, because some bets are just always worse than good, right? So that should be like number 1. The idea that you get out of this video is that, okay, even if you do want to diversify, you only want to diversify between lots of good stuff, right? You want to diversify between lots of good bets. But even then, it's not so simple, right? So let's say we have a third bet, right? And this bet, like 50% of the time, it goes up 40%. And 50% of the time, it goes up 20%. Again, do we want to diversify between these three? Okay, we definitely don't want to diversify with investment number 2, but we don't want to diversify number 3 with number 1 either, because investment number 3 is just clearly better than investment 1, in the same way that investment 1 was better than investment 2. So even if you have 2 very good bets, you still may not want to diversify between the 2 of them if one of them is just clearly better than the other. Now, in a real world example, do you ever actually know these probabilities? Are they written on the back of the investment? No, you don't. So things are a little bit murkier in real life, but at the same time, you also don't really know about correlations between things, right? So that's a whole other bag of can of worms. So let's talk about that. So another really big concept in diversification is that you really only want to diversify between things that are uncorrelated, right? So let's say there's two things that could happen. You could have like economic boom, or you could have an economic recession. Okay? Well, let's say they both have like 50% probabilities. And let's say, okay, investment number one, in a boom, it goes up by 25%, and in a recession, it goes down by 25%. And let's say investment number two, in a boom, goes up 30%, and in a recession, it goes down 20%. So you can probably kind of catch what I'm trying to explain here is, okay, even though both of these investments theoretically, they've got their upsides and their downsides, and you might think you want to diversify between the two, they're actually like highly correlated. So when one goes up, the other goes up, and when one goes down, the other goes down. And given the fact that they're so correlated, you actually would never want to diversify investment one with number two, because number two is just clearly better. And this is actually highly typical of what happens in the real world. In the real world, when something goes up, usually everything is going up. And when, like, let's say, for example, stocks are going up, that means crypto is also probably going up. That means that the housing market is also probably going up. And that means that magic cards are probably also going up. And the same with the reverse during a recession. And this is due to liquidity. Basically, prices all move up and all move down based on what kind of liquidity you have in the system, whether you have low liquidity or high liquidity. So things are actually, they tend to be very correlated due to how they're all kind of driven by monetary policy, or they're all driven by the liquidity that is going on in the market. So that's like one more factor you want to think about in diversification is like, are these things highly correlated? And if they are highly correlated, why would do I really get any benefit out of diversifying with them? Really, the key idea of diversification when it's good is when things are negatively correlated, right? So what if, for example, you have a counter-cyclical asset? So in a recession, it goes up 30%, and in a market boom, it goes down 20%. Okay, now I can get on board, right? Because now if we mix our portfolio with half and half, they're counteracting each other really nicely. And this is when you want to diversify, okay? So this is like the one situation where I'm okay with diversification. And let's think about like a magic example. So let's say you were speculating in like the standard metagame, and let's say there's like 3 different good strategies. Okay, well if you bought cards from each of the 3 different strategies, then you're kind of hedging your bets, because if one strategy ends up seeing a lot of play, then the other ones will see less, and vice versa, right? So sometimes there are situations within Magic or within broader markets, bigger markets, where you can find these things that are negatively correlated, and then it can make sense to diversify. But you still need it to be, the effect has to overcome the difference in the, basically like the power of returns of the two assets, right? Because if this was like minus 5%, plus 5%, and let's say this was like in a recession, it goes up 60%, down 20%, like even here, like, do you really want to diversify that much between investment 2 and investment 1? Investment 2 is so much better than investment 1, because in the 50% chance it goes up 3 times as much as it goes down, and this is just kind of like an even bet, that you really don't want to diversify so much between these two. So basically there's like these 2 conditions, and they need to simultaneously hold for you to want it to diversify. And that's that they need to be not correlated, ideally negatively correlated, and they need to both be about equal bets. Not just both of them being good bets, they need to both be about equal bets. And how often does that happen in real life? I don't know. So there are some other things we want to talk about in terms of diversification, and this is kind of like utility theory, okay? So, and this is an advantage of diversification. So let's say you're all in on one investment, right? Let's say you're all in on like Bitcoin, 100%. This can actually be kind of scary because what if something happens to Bitcoin and you end up with no money? Let's say some kind of catastrophic event happens, Bitcoin goes to zero, you're left with nothing. This is a super, super scary situation. You kind of don't ever want to be in a situation where where you're completely broke. So you may do something else. You may have 90% Bitcoin and 10% cash, or 10% stock market, right? This is probably kind of cut off, but basically, so the utility theory kind of comes in because it's saying that the first, let's say $100,000 that you have like of net worth is worth a lot more than the next $900,000, right? So you'd want to really make sure that you don't have nothing, and then once you kind of get past that threshold of like, okay, I have enough money to put a roof over my head and to eat, then you worry about returns, right? So that's kind of that's one advantage of diversification I can get behind, is you want to avoid like the super, super terrible outcomes. So if everything goes wrong, you want to still be kind of protected. So that's usually means like you want to have some cash, or you want to basically just make sure like your worst case scenario is not catastrophic. So that's one reason to diversify as well. So I think that pretty much summarizes a decent amount of the stuff I wanted to go over. You can see it gets very mathematical, but I think a general rule of thumb you want to use when it comes to diversifying is, I would just assume like it's not worth it to diversify. Whatever situation you're in, it's so unlikely mathematically that you should just not worry about diversification. You should be much more worried about, what's the best bet here, right? What do I think is going to do best? Kind of, make an educated guess. You're never going to know for sure. And kind of go all in on what you think is best, because, yeah, just the math kind of works out that way. Maybe you want to go between two different bets. You could also have kind of like diminishing returns sometimes. Like for example, in Magic, if you bought like 100 copies of a card, it'd be very difficult to unload those 100 copies, right? So that's kind of a diminishing returns effect. And in those situations, you may want to like, okay, I'm better off buying like 50 copies of two different cards just because it's going to be that much easier to unload it when I need to sell. So these are kind of some ideas. Maybe get the wheels turning in your head about diversification. I'm Luca from FullMagicCards.com. I hope this video was helpful and not too boring, and I hope to see you guys in another video.